Ladies and gentlemen, what do we have here? All right, today we're going to be talking about accounting, mainly financial accounting. This will be a running course series, and you'll get this for free. So please leave a like, subscribe, turn on that notification button if you like what you see. If you don't, hit that dislike button. Okay, so we're going to talk about accounting. What is accounting? Well, let's go back a little bit. Let's go back to the beginning. Okay, where accounting all started. There was some guy, he's credited, often mistakenly, for inventing accounting. I think his name was Bicala or whatever his name is. Okay, anyways, he did not invent accounting, he just observed what was happening out in the world, how people conducted financial transactions. How people conducted financial transactions. Things that you guys do every day, but this was long time ago. Okay, so it'll be like me going to the store, in present day, and also we're strictly talking about the United States, not international. So if you're an international student, this class may not be helpful to you. Okay, unless you are planning to study accounting in the United States. This class is for managers who want to know what the hell is going on with these accountants. Okay, with people who are trying to get into accounting, it doesn't make sense to them. Okay, business students who just need an elective course, they have accounting as a requirement, whatever the case may be, and also for accountants, people who actually want to pursue accounting, get a CPA, all that good stuff. We'll get into it. Anyways, you have this guy who observed accounting, and then he just wrote down what was actually happening. Okay, again, it'll be like me going to the store. I see that Walmart has these cash registers, and people are buying stuff. They're giving the cashier money. The cashier is taking the money, put it in the cash register. Then, if I was really working at Walmart, I would get to see the cash register tapes, um, how they transact conduct transactions with their suppliers, how they buy their inventory, how they sell that inventory, um, and how they communicate all that information to their stakeholders. Okay, so this is what this guy did. Fast forward to today, in present day United States, we have Congress. Congress, the House, the Senate, you guys know. Congress is the head honcho when it comes to us. Okay, Congress established the Securities and Exchange Commission. Okay, believe it or not, there were not a lot of rules when this guy wrote down these rules. Um, they were not actually legally required. Okay, so present day Congress is in charge of the SEC, the Securities and Exchange Commission. Securities and Exchange Commission oversees the securities markets, as the name implies. Okay, primary, secondary securities markets. So think of companies that are publicly traded: Facebook, Walmart, Microsoft, Apple. If you are trading on a major financial exchange, um, then you fall under the eyes of the Securities and Exchange Commission. Okay, Securities and Exchange Commission established the Financial Accounting Standards Board. Financial Accounting Standards Board is a very important board to us. Okay, they issue authoritative, generally accepted accounting principles. Okay, or just accounting rules. Okay, they issue accounting rules that companies who are publicly traded have to follow. Okay, companies who are publicly traded have to follow. There are other boards. We're not going to worry about that. This is the main one, and these are our Bible. This is our Bible as accountants. Okay, remember management. You might think, um, I don't really need to worry about generally accepted accounting principles. I don't really need to worry about the Financial Accounting Standards Boards or the SEC. Guess what? You are responsible for the financial statements. As managers, you are responsible for the financial statements, regardless of whether or not the accountants are the ones who compile them. You are responsible for the financial statements. That's why accounting should be important to you. Okay, so This is the background of accounting, and this is where we are today in 2019. Still follow GAAP. And again, we're talking about the big dogs, okay? The corporations that are traded um, on these financial markets, okay? Publicly traded companies. Anyways, rambling too much. What does accounting involve? Accounting, what is it? What is it? What is accounting? Okay, it involves IRC. Okay, identification, recording, communication. Communication. Okay, counting does not involve spelling. Okay, counting does not involve math. If you can do subtraction, addition, multiplication, and division, you are set to go with accounting. Okay, you are set to go. Okay, so let me erase this real quick if I can. Cut. Okay, so identification, recording, communication. What are we identifying? We are identifying economic transactions, monetary economic transactions that affect economic entities. Okay, economic transactions that affect economic entities. Okay, what is an entity? You have proprietorship, you have partnerships, and then you have the big dogs, which are corporations. This is the focus of this class, corporations. Okay, corporations, they generate 80% of revenues for the United States, but there are only 20% of them as far as types of economic entities. Proprietorship partnerships, they account for 80% of economic entities, but they only generate 20%. Okay, the failure rate for proprietorships and partnerships is much higher than a corporation. Okay, proprietorship, one individual that runs everything. Okay, legally speaking, they're not separate from the economic entity, the financial transactions of the economic entity. Guess what though? For accounting, they should be separate. Okay, the financial transactions of the proprietorship have to be separate from the owner. Partnership is a proprietorship plus one. Proprietorship plus one. So you have to have at least two partners, they call them. Okay, and they split everything 50-50. For any of these economic entities, again, the transactions have to be separate from the owner. Okay, legally speaking, proprietorship is not separate. Partnership, everything flows to the owners. Corporations, different story. Legally and financially speaking, they are separate from the owners. Okay, there are some advantages. Proprietorship, partnership. Um, Proprietorship, partnership. You take, you get all the revenues, right? You get all the revenues, but you incur all the losses. Corporations, you get the revenues, okay, but you enjoy limited liability. Okay, that means in terms of the corporation tanks, your creditors, suppliers, whatever the case may be, will not go after your personal assets as an owner. In a proprietorship or a partnership, they can. Okay. Um, all right. So corporations also, one disadvantage of a corporation is double taxation. So you get taxed as a corporation, and then stockholders, when you give them money, they get taxed on that as well. Okay, for tax purposes, proprietorships, partnerships, everything flows into your individual returns, and then you get taxed on that once. Okay, so corporations have many owners, many owners. called stockholders, and this is who we work for as accountants. Okay, we work for stockholders, the public. We want to provide reliable and relevant information to the general public who are interested in our corporation. Okay, inside the corporation, you have management, you have employees, which are also which management is also an employee. Difference between management runs the corporation. Then you have some lower level employees who just do the day-to-day jobs. Um, but here you have stockholders externally, which are our main concern, and then you have creditors, which are external stockholders that are interested in our company. Okay, creditors give us money, which we have to pay back. They charge us interest. Stockholders, we give them a piece of paper. They give us money. We invest that money. Sometimes we give them dividends. Don't have to. That's how it works. Okay? So, anyways, we are talking about economic transactions that affect the economic entities. Also, economic entities don't have to be one of these three. They could be a state, municipality, non for profit. But we are focusing on the big dogs, corporations. Okay? And we're talking about monetary transactions. We're talking about transactions that we can assign a monetary value to. Okay? If you can't assign a dollar value to it, as accountants, we don't give a shit about it. Okay? Anyways, so let's go further. Corporations, inside the corporation, okay? Inside the corporation, you have management. So that's inside. Outside looking in, you have stockholders and creditors. Okay? Management works for stockholders. Management or the corporation borrows money from creditors. Okay? So, for financial accounting, for accounting in general, you have two types. This right here, internally, we're talking about managerial accounting, and that's for management. Managerial accountants do not have to follow GAAP. Okay, they do not have to follow GAAP. They just work on the fly, whatever management needs. So think forecasting, that's managerial accounting. Budgets, we need budgets to whatever. What product lines can we cut? What product lines are costing us too much? Think of, I don't know, human resource. Who can we fire? Do we have enough money that we can increase the wages for these employees? Okay. Then we have the external stakeholders, and that is financial accounting. Okay, financial accounting, you have to, at the end of the day, communicate financial information. Whatever transactions you went through as a corporation, you have to communicate that to stockholders and the general public. So you fall under GAAP. Okay, you fall under GAAP. You are going through more scrutiny. But then again, it's a weird relationship. Management is responsible for the financial accounting information because in the early 2000s, management just played dumb. We don't know. Just blame everything on accountants. A lot of financial accounting scandals happened, and management just said, "We don't know. Talk to the accountants. What the hell? What the hell is accounting? I don't know shit about that. Talk to the accountants." So now, management is responsible for the financial statements, which we'll see later. Okay. Anyways, so we're talking about financial accounting. Let's continue on, regardless of which one you're choosing. Okay. The second step in accounting is recording, and recording involves AJL. Okay, analyze, write down what happened. Okay, or journalize, and then give us an accumulated balance for each account. Okay, this will make sense later, but that's what recording involves. If you're going to be a bookkeeper, this is your world right here, recording. Communication. What are you communicating? Okay, so you have all these transactions, you have your journal, you have your ledger. What can I do with this information? How is it useful? Is it not useful? Is it relevant? Is it material? Okay, so you analyze the information, and that's part of communication also. Okay, or interpret the information. Then you communicate the information in the form of financial statements. Financial statements. Okay, these financial statements, if you're talking about financial accounting, they go out to the general public, so creditors, stockholders, any stakeholder that's interested in the corporation. Stockholders, why are they interested in the corporation? Well, stockholders, they buy stock. Okay, so they're going to take a look at the financial statements and they're going to decide, should I invest in this company and buy stock? Okay, if they're existing stockholders, they're going to take a look at the financial statements and say, should I continue to invest in this corporation? Or should I sell my stock out in the secondary markets or primary, whatever? So they make these decisions based on the financial statements. Creditors, they take a look at the financial statements. They take a look at the ability of the company to pay its debt. Okay? So how much debt do you have already? Do you have enough assets to pay your debt? They're interested in stuff like that. Should they loan you money? Should they keep continuing to loan you money? Based on the financial statements that you issue at the end of each year. Okay, so financial statements are issued at the end of each year. Another difference between financial accountant and managerial accountant. Again, managerial accountant, management can want a forecast or a budget at any given notice. Okay, so monthly, quarterly, every 6 months, every 9 months, who knows? Okay, they don't have to follow GAAP. Financial statements, there are rules, there are levels to this shit, young boy. Okay, so you mainly communicate with the external people through financial statements. What are the financial statements? Well, let's see. Can we go to Google? Come on, Google. Financial statements. And let's see. Relationships. Alright, let's see here if we have a good graphic. Looks like this one will work. Can I blow this up? I hate Google. Never mind. Okay. So we have here an image of the financial statements. I apologize if you can't see it too well. Okay. We have balance sheet. We have a statement of cash flows. We have stockholders' equity statement. And we have an income statement or a statement of income. Whatever you want to call it. Cash flow statement explains cash, what happens to cash. It's a big asset. Let me see, maybe there's a better one here. Oh, much better. Much, much better. Okay, so we have the income statement. So your revenues minus your expenses. It explains your daily operations. Okay, what happened on a day-to-day basis throughout the year. Okay, you're obviously having this corporation or you establish this corporation to generate profit. Okay. Then that transfers over to the stockholders' equity or the retained earnings statement. And then, your net income, you can retain it or you can give it back to stockholders in the form of dividends, which you do not have to pay. That's the beautiful thing about it. So as you can see here, you have your net income transferred over to the stockholders' equity. Then you take out your dividends, and then you have your ending retained earnings statement or retained earnings balance. Don't worry about this too much. I just want you to know the names of these financial statements. We'll cover each one in a future class. Okay? Balance sheet. We have assets equals liabilities plus stockholders' equity. This is the bread and butter. This is the most important statement, in my humble opinion. And it's your accounting equation. Okay? It's in every introductory accounting course, intermediate, advanced. You have to know the accounting equation. Most important. Cash flow statement explains what happens to cash on the balance sheet. Okay. Cash outflows, cash inflows. Cash outflows, where did you spend your cash? Cash inflows, where did you get cash? Okay. And that's all for the financial statements. And this is what external stockholders look at. Okay. External stakeholders look at. So stockholders and creditors, as you see here in this poorly drawn graphic. Anyways, that's it for this lesson. And if you enjoyed this, if it was helpful, please hit that subscribe button. Give me up, up, up. Hit the like button. Hit the notification button. If you don't like this, shove it up yours. Asshole. No, I'm just joking. I'm just joking. Okay. But that's it for this lesson. And in the next lesson, we'll talk about the most important thing, the balance sheet in the form of the accounting equation. Okay.